Okay, so welcome to the Local Pension Committee, held on the 4th of June 2021 at 9:30 a.m. First order of business is election of chairman. Mr. Barclay was nominated chairman-elect at the annual meeting of the County Council, held on the 19th of May. Can I ask the committee to confirm this is agreed by a formal nomination and seconder? Okay, I take that as agreed, Mr. Barclay.
The next item on the agenda is the election of the vice chair, and I nominate Mr. Grimley. Could I have a seconder? All those in favour?
Chair, can I just come in? In order to have a balanced ability, it would be nice if we have a vice chair from city representative. I understand there are many representatives from county and area. In order to have a balance.
Appreciate what you're saying. Mr. Grimley has been elected as vice chair. Thank you. Minutes of the meeting held on the 26th of February 2021. I propose that the minutes of the meeting held on the 26th of February 2021 are taken as read, confirmed and signed. Is everyone in agreement? Thank you. Item number 4, I have received no questions from the public. Questions asked by members under Standing Order 7.3 and 7.5, which is item 5. I've received no question from members. I have not been notified of any urgent items. Item 7, does declarations of interest in respect of items on the agenda. Does any member have any interest that they wish to declare? Yep.
Chair, Councillor Murray, I'll take advice. Up until 3 weeks ago, I was a pension trustee for a centre of the company I work for. I resigned. However, I'm still, as of this morning, shown at Companies House as being a pension trustee. They haven't formally taken me off the list.
Thanks.
So I'll take advice on that. Thank you.
Thank you. Thanks. I think probably best to declare that, and then it's transparent. But thanks for doing that. Thank you.
Okay, Chair, I formally declare that as a non-pecuniary interest. Thank you.
Lovely. Thank you. Next item, the first item on today's agenda is LGPS Central Update. We are joined by Joanne Seegers, Mike Weston, Gordon Ross and Patrick O'Hara from LGPS Central for this item. Bhulesh is going to introduce the item. So over to you, Bhulesh.
Thank you, Chair. So just a quick update on this standard paper that we tend to have quite regularly. So we've got 4 items on it. The first is a quick update on the budget for LGPS Central, followed by a presentation delivered by Central that will cover the fund's performance versus benchmarks and targets, responsible investing, how it's incorporated into manager selection and ongoing monitoring, and an update on decarbonisation and engagement, which is quite relevant given some of the letters some of our members have been having recently. A bit of background for our newer members. Central is a pooling company that is jointly owned by 8 Midlands-based local government pension schemes to deliver investment pooling. Went live in April 18. Our fund is one of the 8 owners, and at the current time, we've pooled about 50% if you include our passive holdings. So that's about 2.6 billion of our 5.1 total fund value. Moving on to the central budget, it was approved at the last meeting for the company in February. It's 12.4 million. That's the money needed to run the company in total for the year. It's made up of a base of about 11.7 million plus an inflationary increase of about 150. They are able to ask for additional funds as and when new products are launched. It does also include, one-off costs like moving to a new office and bits and bobs like that. We've got Central moving to a new office in Wolverhampton later this year. MHCLG are also moving there. You may have already heard. So I don't think there is no decisions for this. So committee's just asked to note the report, and I'll like to hand over to Central to start their presentation.
Okay, thank you.
Hello. Well, perhaps I can kick off for LGPS Central. And for those of you who've not met me before, my name's Joanne Seegers, and I have the pleasure and the honour of being the chair of LGPS Central. And it's really kind of you to invite us to your meeting today. I certainly see a very important part of our role is meeting with our pension committee, our partner fund pension committees, and being able to hear firsthand your views on the work that we're doing, and to talk to you about our progress, but also for you to give us your views on our direction of travel. So it's good to see you today, albeit virtually, but of course, really looking forward to the time when we can come and meet with you in person. But it's good to see so many familiar faces, but also some new faces too. And before I start into the detail of the presentation, I should say that I'm joined today by my colleagues, Mike Weston, who's the Chief Executive Officer of LGPS Central, Gordon Ross, who's our Chief Investment Officer, and Patrick O'Hara, who is our Investment Director for Responsible Investment and Engagement. And you can see our pictures on the screen today. Also, we're joined by Callum Camel and also Cara Forrest, who work in our client relationship team. So we're all very, very pleased to be here with you today. And let me also start by saying a big thank you to the support we get from Leicestershire County Council Pension Fund. Your support has really been invaluable, and the expertise and the input we get from Bhulesh and from Chris and the team is really, really important in now being able to make the progress that we have made on your behalf over the years. So thank you very much for that. And if we could move on then to the next slide. What we're going to talk to you today about today is really the work we're doing generally, but very specifically with your fund, to give you, as it says here, an investment summary on performance, but also focus on responsible investment and engagement, because we know just how important that is to our partner funds, including yourselves. So that's really what we want to cover today. But I thought I would start by giving you an overview before I hand over to Gordon and then Patrick and then Mike. So if I might have the next slide. Thank you. And the next one, thank you. And I'm going to start with our philosophy, because that really drives what we do and how we operate. And our philosophy is very simple, really, that we exist because of you. You are both our shareholders and clients, and Bhulesh described to you, the ownership structure. And so it's our job to operate in your interests and only in your interests, and to build the funds and to build the investment approach that really helps you and meets your investment needs. And at the heart of all of that for us is good governance, making sure that we as a board operate in the interests of our shareholders, and making sure that we have the robust processes and systems and structures in place in order to be able to meet your needs as our investors. And today, after just really 3.5, 4 years of operation, we are responsible for 22 billion, just over 22 billion pounds of assets under management or stewardship. And that's about half of all pension funds assets across the 8 partner funds in the pool. And as you just heard, around 50% of all of Leicestershire's assets have transitioned into the pool. And those assets are managed or operated or stewarded over 14 investment vehicles in both the public markets and private market sector. And Gordon will explain a little bit more about that in a moment. And I'm pleased to say, and I'm not going to steal Gordon's thunder, that despite very, very trying market conditions that we all know about because of the COVID crisis, performance has been strong. And you can see there, four funds ahead of the benchmark since inception. I think that is a testament to the expertise that exists within LGPS Central in terms of stewarding and managing those funds. And of course, we are able to do that. We are able to manage those transitions. We are able to deliver those performance returns because we've built a strong team at LGPS Central. We currently stand at around 60 people. And we've built a team who've come into LGPS Central, for those of you who are perhaps not familiar, from the LGPS sector, including, of course, Colin Pratt, who was previously of Leicestershire Pension Fund, so from partner funds, but also from the investment sector and the private sector. And so we've got what I think is a really excellent blend of public and private sector philosophy and expertise and culture within LGPS Central, and expertise in the public market sector, in the private market sector, and in the what we call the back office sector, who can really just make sure that assets get transitioned well, and that we are stewarding that money and we're reporting on the investment performance and the funds to you effectively. I talked about our philosophy earlier, and a core part of our philosophy, and it has been from the outset, has been a focus on responsible investment and engagement. We know that we have to be, and we must be, responsible owners of the assets that you put under our management. And again, Patrick's going to talk to you in more detail about this later. But that focus on stewardship is absolutely essential, and we know just how important it is to you. And indeed, it's one of our 5 priorities for this year. So, well, I'll leave Patrick to talk about that in a moment. So that's what we've done and how we've got to where we've got to. If I look forward to the rest of this year, we have a very busy year ahead of us, building more funds based on the input we get from our partner funds, from all our partner funds, to build those funds that you collectively tell us that you want us to build. So we've got five funds on scheduled for launch over the course of this year: private debt, private equity, targeted return, sustainable equity, and property. And again, Gordon and Mike can talk about that in a moment. So as you can see, I hope that we've come a long way in a short time, but we've got much more to do and further to go. So with that, I'm going to hand over to Gordon, who's going to talk about investment and investment returns. Gordon.
Joanne, thank you very much. Good morning, Chairman, Pensions Committee. Good morning. My name is Gordon Ross. As you've heard, I'm the investment CIO, Chief Investment Officer here at Central. And the next few slides will just be to outline the products that we have developed in conjunction with partner funds, but also more importantly with Balesh and the colleagues here at Leicestershire for your needs. You can see here on slide 6, there's a list of the assets under management in the funds that you're exposed to in the pension. And you can see it's a complete range of both active and passive, of public and private markets. And there is at the back of this presentation an appendix on page 15, which goes into more detail as to exactly what these funds are. But suffice it to say, the allocations here are literally taking the world. So you have, on the equity side, a mixture of global equities and emerging market equities in 2 different funds. On the fixed income and debt markets, you have investment grade corporates, you have a fund covering emerging market debt, and most recently, a multi-asset credit fund. When I say most recently, it was actually launched in the last few months. And then on the passive side, we have a World Equity Climate Multi-Factor Fund. This is a passive equity run against a specific index. And in the private markets, we have a primary partnership, which was a 2018 launch. And these are going to be continued in different launches, different vintages. As you've heard Joanne said, we're looking at private debt and private equity going on for this year. Of your allocations, you own up to, but not more than, a third of any of these funds. The largest exposure you can see here is on the recently launched multi-asset credit mandate that has a benchmark against cash with an outperformance target, which I'll go into in a minute. And then we are working again with Balesh and the team on designing other specific funds. I suppose most recently the Targeted Return Fund, which is in progress of having its procurement and design finalised. And I know that he's talking to our colleagues on the Targeted Return team here at Central. If I could turn to the next slide, please. So this is the slide showing the performance. Now, we measure the performance twofold, once against its target, once against its benchmark. Now, obviously, the funds here we design to have not only a benchmark to indicate how well they're doing, but more importantly, an alpha target above it. And our aim is obviously to achieve that target. And you can see the green and amber signifies the fact where we have either achieved or beaten either the benchmark or the target. The amber one is where we have beaten the benchmark, but not yet attained the target. So as Joanne said, you can see that all 4 of these funds have outperformed their benchmark. Within these funds, you have some 10 individual managers. And so those managers themselves have outperformed. In all cases, with the exclusion of the passive mandates, which we run internally here at Central, we have a procurement process which we have designed since we started. It's been tested, it's been very successful. And this includes not only manager selection on the due diligence process using OJU-like templates, making sure that there is a standard questionnaire, then an RFP, and more important, or as importantly, on-site due diligence meetings. These also incorporate RI and ESG factors, as Patrick will describe in a minute. But this process has developed, has been improved as we go along. And internally, we're obviously very pleased that the managers we select are continuing to beat their benchmark. We obviously are making sure that we're continuously monitoring them. We have discussions with them on a monthly basis to make sure that they actually attain their benchmarks. And therefore, that is the goal that we have set ourselves. And that is the goal that these mandates are designed to beat. So whilst we've beaten the benchmark, we're not quite there on the targets. You'll see at the bottom there, the Climate Factor Fund. This being a passive fund is running as an index. So the measurement here is not specifically against the target, because you would obviously expect a passive fund to match or be very close to its target. We have a tracking error target, a range whereby the variance or the movement against the underlying targets is measured. And as you can see from this, the performance has increased over time. If you're those who remember these presentations before, this improvement has continued. May I have the next slide, please? So the private markets, there is a primary partnership 2018 vintage, as I said. This continues to do very well. For those who may not know, private markets, the valuations tend to be slightly lagged just due to the nature of the beast, the valuations of the underlying instruments. And also the fact that the monies are committed, they may not be invested in the securities at a certain time. So this fund, the 2018 fund, is about 60% invested in the underlying securities, but continues for those invested monies to perform very well and substantially outperform the target. Again, this was a very blue chip private equity market, and we continue to expect this type of performance going forward for its life. And I think, unless there are any other questions, I will hand over to Patrick.
I think we have a question, Elise. You have a question.
Slide 7.
Yep.
Target and benchmarks. Now, I imagine benchmarks are against comparatives and targets. Who sets the targets? Do we set target?
Yes. Sorry. Yes, so as part of the design, every mandate obviously has to have something to be measured, which is the benchmark. So the benchmark will be reflective of the universe. So if I take the investment grade bond fund, it has a global investment grade benchmark that is designed purely for our product because of the partner funds, your funds and fellow funds design and requirements. Obviously, all your liabilities are in sterling. Historically, there has been, before the pooling, various partner funds were in sterling only, or some were in global or multi-currency corporate and credit funds. So we designed the benchmark to reflect the universe of the investable securities for the manager. We then work with you, with Balesh and the other partner funds to find out what a achievable and desirable target of alpha above that benchmark is. So yes, it's very much partner funds, yourselves included, that design that. Obviously, we try and make sure that it's a realistic target and that one that will obviously achieve the results, the income or the results you require us to provide the pensions. But we want to make sure the managers are able to actually achieve those targets. Otherwise, it will be a fruitless exercise. But in answer to your question, you are involved in the target choice.
Thank you. Right, that appears to be any more questions from anybody? No, no more questions. Thanks, Gordon.
Thank you very much.
Thank you, Gordon, and thank you for the opportunity to come and speak to you today. I joined LGPS Central at the beginning of the year to head up the responsible investment team. Prior to joining, I worked at USS Investment Management, so managing the assets of the University Superannuation Scheme, and I was responsible for ESG integration and engagement in public markets, so listed equity and fixed income. And prior to that, I did a similar role at Viva Investors, so I'm very happy to be here. Could we move on to the next slide, please? So we just wanted to give you an overview, a high-level overview of our approach to responsible investment at LGPS Central. And this can be characterized in two ways. So selection, which generally happens before the investment takes place, and stewardship, which happens after the investment takes place. Sorry, for some reason I lost connection there for a moment, apologies. So on the selection side, this is split between those assets that are managed internally, which is our passive assets, as Gordon just mentioned. So this is the
Patrick, can you hear us?
Patrick, can you still hear us, Patrick? You seem to have frozen on the screen. You've come now. You've come back.
Sorry. Yeah, sorry. Apologies for that. That must be something to do with half term, I would imagine, and bandwidth capacity. But I'll plow on. So as I mentioned, the first part of our selection process is on internal assets. So when we set up the internally managed portfolios, we make sure that we maintain voting rights on all of the companies held within those portfolios, and we set them up for engagement activities. And we also will then, for example, the fund mentioned there is the Passive Equity Climate Multi-Factor Fund. So we'll work with the team establishing that to make sure that we contribute to the discussion and due diligence around data providers and tilts and various approaches to managing ESG risks embedded within that portfolio. And then on the external side, it's very much due diligence on the external managers. So we will look quite closely at their philosophy around ESG integration and responsible investment to understand why they do it, make sure this isn't just a bandwagon that they're jumping on, that there is a commitment to making better investment decisions through robust ESG integration and analysis. And then we'll also set up those portfolios for voting, so we retain voting rights on all our externally managed portfolios, because we want to vote those companies we want to vote at the AGM in accordance with our voting policy and our our beliefs around diversity and independence, and also to integrate other environmental and social factors into our consideration of how management are performing and how they're reporting and disclosing to investors. And if necessary, that will be reflected in the IMA and side letters when the relationship is established. And once that relationship with the external manager is established and we've got comfortable with their credentials, we'll be looking at the people, process, systems, and their collaboration within the industry. We will monitor that on an ongoing basis. So we have quarterly meetings with those external managers, and we ask them to talk us through any decisions they've made in the intervening period. We'll ask them to discuss any particular companies in the portfolio that stand out from an ESG or responsible investment perspective. We will ask for an update on their engagement activities in that period, and we'll also monitor the portfolios in terms of the overall ESG rating of those portfolios and the carbon footprint. And we'll look and do a deeper dive into the companies that are driving the carbon performance of those portfolios. And this is all, making sure that those external managers deliver on our expectations on an ongoing basis. All of our funds, both internally and externally managed, require RI integrated status. So that's an internal certification that we've established to make sure that as a house we're comfortable that all of our assets are being managed appropriately, and that's a board target for 100% of our assets to be managed in accordance to achieve RI integrated status. So that's a key metric that we track and a key label that we established with all of our assets. And then so whilst we expect our external managers to engage with the companies within the portfolio on key ESG issues, particularly those that are material to the performance of the company or to the portfolio, we will also do some of that engagement ourselves. So high profile companies within the portfolio such as Shell, Glencore, we will engage with ourselves. We will liaise quite closely with the external managers on their approach to engagement with those companies. And we will embark on collaborative engagements with the industry, so other investors working together, such as the Climate Action 100 initiative, where we're the lead engager for Glencore, through other industry bodies that may be engaging with government, regulators, and policymakers. And we've signed up to a number of initiatives on that front, engaging with government around TCFD reporting, on climate analysis and scenario analysis, and also on responding to consultations from local government departments on matters such as the just transition, and also on regulation around climate reporting for pension funds. And one of the advantages to the approach we take is that we really try and join up our voting with our engagement. So what we learn through the engagement with the company and through our interaction with our external managers who hold the company, that will feed through to our voting at AGMs, and you can see that we vote against at least one resolution at approximately half of the AGMs that we vote at. And we had a recent situation with Motorola as a company that we were trying to engage with, and they weren't very responsive to our approaches to engage on their activities in the Israeli occupied territories, and therefore we felt it appropriate to vote against directors at the AGM. So we will do that as well. We will integrate those considerations into how we vote on directors, as well as filing resolutions. We filed a shareholder resolution at Barclays last year, asking for the company to set targets around decarbonisation. And we will obviously support other shareholder resolutions. We give careful consideration to all shareholder resolutions, but we vote on them on a case-by-case basis. So overall, that's our overall approach. I would suggest that when you're not managing the assets yourself, selection is really, and that ongoing monitoring is really how you approach ESG integration, and how you embed that in how your assets are being managed, as well as your stewardship activities. Should we move on to the next slide then, please? So just to drill down on recent events and also some of our engagement activity with Royal Dutch Shell. And as you know, we favour engagement rather than divestment. We think that all assets and all companies are different. They face different risks, different transition risks, different physical risks, different risks associated with stranding of assets. And therefore, we feel that they should be both engaged with as individuals rather than as a sector, as individual entities, but also they should be analysed separately. And therefore, ESG integration we consider is the optimal approach for both maximising investment returns, but also managing risks associated with environmental, social and governance issues, and also in terms of impact, that we can bring about positive impact through our engagement activities with companies. And we have done so through engagements on human rights, plastics. We're engaging with companies now on taxation and responsible corporate taxation policies. So with Royal Dutch Shell, they're a company that have embraced a dialogue with investors over a number of years now, and that's resulted in them both setting carbon reduction targets, both on their emissions associated with their operations, but also their carbon emissions associated with their products. And then if you compare that to ExxonMobil, who are a company who really didn't engage in the same way, whose business model was very much business as usual, to continue, exploiting their fossil fuel reserves as much as possible, and not really looking into the future and engaging with investors around the risks that were on the horizon posed by climate change and the changing regulatory environment. And this recently kind of manifested itself in a vote at the Exxon AGM, where two directors were voted off and replaced by two directors selected by activist investors. And a very small hedge fund that owns 0.02% of Exxon was able to achieve that. It got widespread support amongst mainstream investors, and it was really kind of evidence of the mainstreaming of ESG and responsible investment. And therefore, I think we're seeing the world changing. We're seeing very much the results of many years of engagement activity that investors have embarked upon with large corporations, particularly the fossil fuel industry. And so I think we would recommend that approach continues, that ESG integration and engagement and stewardship is the appropriate and optimal approach to navigating the transition to a lower carbon economy and all the risks and opportunities presented by that. If I'm happy to take any questions or continue to the next slide.
We just have one question.
Sure.
Oh, Nick.
Yeah, thank you. Interested about the issue about pressure on voting. Do you use the remuneration committee votes as well as the sort of voting for directors and shareholders' resolutions? Because would you consider a sort of general rule that you would vote against the remuneration of directors where the company doesn't achieve the model for achieving the Paris climate change targets?
Yes, we would consider that. We have an expectation that there should be a target around decarbonisation stroke Paris in remuneration policies already, and even broader ESG metrics such as health and safety metrics we consider should be in there. We do actively vote on the remuneration policy, so we'll look at all aspects of that. We would use the advice of our proxy voting provider and our engagement provider in making those assessments, but that's certainly an option. We would also vote against reporting accounts if a company is not disclosing sufficient information to us in a world where integrated reporting is the way forward. If they're not disclosing that information, then I think we're entitled to come to the conclusion that the company's disclosure is inadequate. So we would also vote against reporting accounts. I mean, we'll generally take a case-by-case basis. And with some of these things, it might be appropriate to send a warning shot across the bows via an abstention in the first year. It all depends on what access we have to the company through our engagements as well. If that conversation is better had face to face rather than through the vote, that's something we might do. But that's definitely an option that we would use.
You happy with that?
Okay, yeah.
Thank you. Alan, you wanted to ask a question. You did.
I did. It's Adam, Chair. It's Councillor Clark from Leicester City Council. The correlation between the recent court decision of the Dutch courts against Shell and the pension fund process. What is that correlation? And secondly, in terms of COP26, is there a sense that or a risk that we are behind the curve here in terms of promoting responsible investment, and there could be a sea change in the approach at COP26? And how do we judge that? Is the pace of the pension funds behind the curve is my pointed question.
On the first part of the question, I think there is a strong correlation. I think if you look at the AGM of Shell recently, 30% of investors voted in favour of a resolution that asked the company to align their carbon reduction targets with Paris, which was basically the sentiment that was expressed during the court case that the company needs to do more. It is responsible for its emissions, and it needs to take ownership of that and accelerate its decarbonisation. So I think there's a very close correlation there. The NGO that was behind the court case, Friends of the Earth, they work very closely with investors, and we have lots of interactions with the NGO community. So I think investors and NGOs have been working together on ESG related issues for some time. So I don't think it's entirely, they're unconnected. I think they are quite closely correlated. On your second point, yes, I think it's difficult to predict what will come out of COP26. The UK government certainly moving fast. And I think as pension funds, we do need to embark on horizon scanning and prepare ourselves for regulatory change. We've seen the Department for Work and Pensions introduce regulation around reporting and analysis. I think LGPS Central is in quite a good position for that because we embraced TCFD reporting some time ago and we got ahead of the curve. There are a few things that we might need to do, for example, analysis around scope 3 emissions. There's very limited data out there to use for that sort of analysis, but that is something that I think we'll need to develop further. I think we need to continue to revisit scenario analysis and stress testing as it evolves as a discipline. Again, some of the data challenges have meant that the outputs from that analysis are not as reliable as perhaps investors would like them to be, and therefore not as decision relevant as we would like them to be at this point in time. But I think that will evolve and change. And certainly, COP26 is a live conversation within LGPS Central. It's something that we are acutely aware of. We're talking to other pools on that front in terms of in the run up to COP26 and what role the pool should play in those discussions. So I think, and we need to continue on that front, and including the discussions around net zero and net zero commitments, and what that would mean, how that could be implemented. That's again something that's a live discussion.
Very helpful, Chairman.
Thank you. Mr. Govin.
Thank you, Chair. I've received an email from a friend of ours asking some question. And I'm just going to read the paragraph on that. International Energy Agency started earlier this month. There is no need to invest in the new fossil fuel supply in our net zero pathway. Beyond the project, there are no new oil and gas field approved development on our pathway. No new coal mine or a mine extension are required. We're becoming a more and more risky safe investment fund. And the fuel, fossil fuel is a very risky area. Where are we going on that aspect of it, please?
Yeah, so the IEA produced its net zero scenario and pathway. It is one pathway amongst a number of possible pathways, and it is a narrow pathway to net zero. It's quite wide sweeping in terms of what would be required to achieve 1.5 degrees of warming. I think we have to be realistic about what is going to happen. And whilst I can certainly see that the coal and no new coal reserves is a possibility, and if coal is kind of usurped by natural gas and renewables, I can see a pathway to eliminating coal in the next 10 to 15 years. It's hard to see, I think, that pathway for gas and oil. And I think that's particularly true when we remember that the vast majority of oil reserves are not in the hands of private companies. They're in the hands of governments, and we would need the governments of Russia, Saudi Arabia, Qatar, Venezuela, all of the OPEC nations to agree to not develop any further oil and gas reserves, which I think is an unlikely outcome at this point in time. And also, I do wonder if, even if that was the outcome, what impact that would have on the price of oil in the short term. So I think as investors, our role is to try and assess the world as it exists today and how it's likely to evolve over the next 2 to 3, 5, 10 years. And unfortunately, that may be different to how the IEA scenario predicts a route to a 1.5 degree world. I think my position on this is that we need to consider and look at companies and as individual entities, analyze them as individual entities. By doing so, you're most likely to get closest to the answer, and to manage risks most effectively by doing that. I think if you look at sectors as a whole, you're going to miss some of the story there. And I think there is a role to play for some companies such as Shell and Total, who may well evolve and develop into energy providers from oil and gas companies. They may well make valuable contributions in terms of renewable energy, carbon capture and storage, and other technologies that it seems likely that we're going to need if we are going to achieve net zero and the targets set out at Paris. And I think the best way for investors to participate in that is through engagement with those companies.
Okay, well, Chair, if I may, yeah. What I'm going to do, sir, I'm going to forward this email to Kat, and she may be able to forward it to you. Can you respond me on that context? Because there's quite a lot of context. I've only asked a proportion of it. My colleague also asked on COP26. It would be nice if we could have some detailed information, but I can at least answer the person who sent me the email.
Thank you, Mr. Govin. I think we've all had lobbying emails, and I think Patrick has cleared very extensively how we're responding to it. And I don't think it is appropriate to do any further than that. I mean, he's gone into a great deal of detail, and it isn't fair to ask any more. So we will accept what Patrick has said. And if you have any other questions to ask him now, please do.
Chair, no, I think that's because mostly my co-councillor has asked. And,
Thank you. We were very, very aware of the environment and climate issues. As a pension fund, you can see what trouble they've gone to do it.
Right.
And it isn't an agenda item that's going away. It will be here, and in future meetings, if you have any queries, please ask. But our influence on the governments of Saudi Arabia, Qatar, and Venezuela is limited. I think we have to accept that.
I accept.
Thank you, Mr. Govin.
Thank you.
Have we got any other questions on this before we move on and hear Mike's presentation? No, we haven't. Thank you very much, Patrick.
Thank you. Thank you, Chair, and good morning, councillors. I'm conscious that we've probably exceeded our agenda slot already, and I was just going to give a summary, so I'll give a very quick summary. And we'll take any remaining questions. If we could have slide 13, please. Thank you. So in terms of the way forward, most fundamental in terms of what we want to do is to deliver the investment performance that you need on the assets that you have chosen to put into the pool for us to manage, so that secures the pension payments over the long term to your members. So that's fundamental to everything we do and will be key to our way forward. In terms of other things, we already, hopefully you'll have got from this morning and all of the background, that we have a really strong relationship with yourselves at Leicester County Council Pension Fund. And what we want to do is build on that relationship and strengthen it going forwards. You've heard from Gordon and Joanne about the new products that we're building. So we aim to deliver those new products as we go through this year. Targeted return is one that you're specifically interested in, as particularly important for your fund. So we'll aim to deliver those products and also continue to develop any new products that you may need as your asset allocation evolves over time going forwards. And as you heard from Patrick, RI integration is essential to everything we do. And we will keep it that way as we go forward and ensure that it's a key part of every product that we launch and manage for you and the other partner funds. And just in response to the last question, we do produce quite a lot of RI output. There's a regular quarterly stewardship report, which is available to we distribute it to you, and it's on our website. So we will continue providing lots of information on all we're doing in the stewardship arena. Chair, that's all I wanted to do in summary. Hopefully my colleagues in advance of me have provided all the background information and responded appropriately to the questions that have been asked this morning. Happy to take any more questions that any members may have. But I would just like to close by saying thank you very much to your commitment for your commitment to the pooling and to us at LGPS Central, and we will continue to do our very, very best to deliver what you need from the assets that you've chosen to allow us to manage. But thank you very much for this morning.
Thank you, Mike. Thanks very much. Has anybody else got any other questions? No, we haven't got any other questions. So great thanks to Joanne. Oh, Claire, sorry, you have a question. Please go ahead. I didn't see you on the screen. Sorry.
No problem. Thank you, Chair. For the benefit of the new members of the committee, I'm Claire Scott. I'm an independent advisor to the committee and the pension fund. Joanne mentioned earlier about the assets under management that you have across the pool, around about half for the partner funds, and obviously Leicester's around about 50%. And I understand West Midlands, which is obviously one of the majority, larger funds within the pool, is obviously really quite significant in terms of size, but also their portion of pooled is high. So that obviously means the others are relatively small. So my question really relates to the potential efficiencies of others doing more pooling. Do you see this as a barrier, a hurdle? What are you doing about it if you are taking that forward? And what can Leicester expect going forward in that regard? Thank you.
Thanks. So, well, maybe if I kick off and then Mike can add some points to. I mean, clearly you're right as ever. That the more assets under management we have, the more efficient we can be, the better we're able to deliver investment return, but also cost savings to our partner funds. So we are working with all our partner funds to encourage them to pool assets, and that's why those discussions that we have at the start of the year, or the start of our ahead of our financial year, as part of the work programme and budget setting process. I'm going to apologise if you can hear noise outside. The council are busy cleaning the roads, doing a great job as my local council, but slightly off-putting. So we're working with all our partner funds to encourage them to transition assets and to make sure that we can have that early dialogue with partner funds to make sure that we can really build the funds that partner funds want, so that we can get those assets transitioned across, because we know that we can deliver good returns, good efficiencies, good cost savings for partner funds, and to expand the opportunity set to partner funds. Clearly, Leicestershire has always invested in infrastructure, but not all of our partner funds have, or private markets, to improve those opportunity sets. And we know that by working together, we're best able to achieve that. So certainly we want to see all partner funds following the footsteps of Leicestershire, to make sure that those assets are transitioning across. But Mike, I don't know whether you've got anything to add to that.
Morning, Claire. The only point I'd add is that since Central was established, we've been very careful to build the functionality of the organisation and therefore the cost base of the organisation in line with the assets that are coming in. So in terms of delivering scale benefits, there's no significant detraction or negative impact on Leicestershire from the spread of assets that other partner funds are put into the pool at the moment. As Joanne said, the more assets we get in, the more efficient we become. But we've always been very careful in making sure that the organisation is built and that costs are built up in line with assets, not ahead of assets, so that we just mirror the transition. The more assets we have, the more scale benefits we will be able to deliver for all investors in the pool, including Leicestershire.
Thank you very much, Mike and John. So it just remains, there are no other questions. So it just remains to thank Joanne, Mike, Gordon and Patrick for a very comprehensive presentation. Committee's asked to note this report. Is everybody happy to do that? That's everybody. Thank you. The next item on today's agenda is the responsible investing update. I'm going to ask Bhulesh to introduce the report.
Thank you, Chair. So this is our regular quarterly update of the RI plan and voting and stewardship report, except this time we also have our first TCFD report, which Patrick mentioned. So that, just so you know, for the newer members, that's the Task Force on Climate Financial Disclosures report. And we also have our first climate stewardship plan appended to this report. So they are appendices D and E. We've got our standard pack first of all. So that's the that's the voting and stewardship and our progress against the 2021 RI plan, which we agreed at the January 2021 meeting for our new members. Importantly, I was just going to just move to point 6 of the paper. In light of the recent and many letters that many members have had, our investment strategy statement does state that we want to ensure through RI engagement of companies and rather than divest. I hope that's come through today, and and the benefits it can bring, in the way that Patrick mentioned with what's happening at Shell and Exxon, for example. I'll quickly touch on the quarterly voting report, which is one of the appendices. And it covers all our LGIM passives, as well as our LGPS central sub-funds, including the Climate Balanced Fund, the Global Emerging Markets Fund, and the Global Active Equity Fund. Together, they encompass about 45% of all our funds assets that this appendices reports on. I won't go into the numbers of votes that were cast and the number of meetings. They're covered in points 9 and 10. and you can see Appendix A for a fuller breakdown. Mike also mentioned the quarterly stewardship report. Points 12 to 16 on page 36 talk about the kind of things that they cover. We've maintained the same stewardship themes, so we still have climate change, plastics, fair tax and tax transparency, and the final one, technology and disruptive industries. They're the areas that the QSR, the quarterly stewardship report, covers. And this is a quarterly report. You can go back onto the website, and LGPS Central's website, and you can look at previous quarterly reports as well. The link is included within point number 12 of the report. I'm just going to quickly touch upon point 16, which is Climate Action 100 Plus. So what Climate Action 100 Plus did, they released its first net zero company benchmark report. And what Climate Action 100 Plus tried to do is they try and focus on the biggest 150 or so companies who are critical in the path to net zero. LGPS Central are a member of Climate Action 100 Plus, and the report does note that only a quarter of the companies reported on those Scope 3 emissions, and these are those emissions that are indirectly impacted by the company. So they're not from the assets that are owned, but they are controlled by the company. They're the ones that are very difficult to measure, if you like. And they also noted the need to set shorter term targets, so you don't end up back phasing or backloading the decarbonisation effect. So it's worth reading that QSR. There's lots of good information in there. We've got a quick update on point 19, which is our 2021 RI plan and our progress on that. You can see that a number of items are completed. Most notably, we now have the fund's first TCFD report, which is points 20, 21 and 22 on page 38. These are just a number of questions that the fund has answered in its response to how we're managing climate risks, and we intend to include them in some way or another in our pension fund's annual reports. The last points on this report are the climate stewardship plan, included as Appendix E, and pages 30 on page 38, points 23 to 25, talk about the plan we have for. There's 9 companies that we aim to bring back to committee later in the year, and talk about how we've engaged and improved their climate characteristics. So they include what we describe as the worst polluters, if you like, or the ones that we need to do the most work on. They exist within our portfolio, and they're the ones that, if we were going to target, these are the ones that we'd be looking at. So we'll bring that back later in the year, but they have been outlined in Appendix E, and the issues that each of those firms have. That's the end of that report. I'm happy to take any questions.
Thank you, Gulash. I do have one question from Marise.
Thanks, Sarge. Climate stewardship plan. We also have large investments in emerging markets. Is there a difficulty in balancing our stewardship plan against poorer countries who actually may not be as green as we want to be, but it is an important part of their economy? I'm thinking particularly of something like Unilever and palm oil, for example. Yeah. Say we can't use palm oil, but it does do an enormous amount to the economy of various countries.
I was just having a quick look through the relevant appendix and the companies that we've included on there, and I look at those companies and I see energy, utilities, materials. They're all large global multinationals. BP, Glencore, Royal Dutch Shell, the Southern Company, Taiwan Semiconductor. So although we do have a bit of emerging market exposure there, they're not probably what you were thinking of there, Councillor. They're the ones that we've included in our climate stewardship plan are the ones that affect our fund the most and have contributed to the climate risk report that we presented for the first time at the back end of 2020. And these are the firms that fell out the back of that, and we're looking to report on those later in the year. Does that provide you with any greater context?
I think it sort of does. It's probably rather a deeper question, but I think that's about as close as we can get. Thank you very much.
Thank you.
Thank you, Vilas. So I cannot see that there are any other questions. So there are no other questions. We are asked to note the report and agree to include the task force for financial disclosure is included within the fund's annual report. Is everybody happy to do that? Yeah, that's unanimous. Thanks very much. So we're on to the summary evaluation of the pension fund investments. I'm going to ask Declan to introduce this report. Thank you, Declan.
Thank you, Chair. This is just a standard quarterly report. So all I was going to do is just draw attention to a few areas rather than sort of go through the full report in detail. So the first chunk of the report just goes through sort of a brief market overview. And I just wanted to draw members' attention to the table in paragraph 2 that just gives us sort of the returns by sort of total asset class. So this isn't the fund returns over a range of periods. And the 3-year column is particularly interesting because you kind of, obviously we've had the COVID crisis and the global recession that brought, which is, you know, and a lot of the sort of the recession metrics is the worst recession we've had in sort of living memory. But you can see from the 3-year figures, you just wouldn't be able to guess we've had such a sort of a drastic decline just purely due to the sort of speed and the recovery. And it does kind of sort of show you there's it's kind of a bit of a sea change in kind of, so I suppose the market movements seem to dictate the expert narrative at the moment rather than kind of the people being able to predict what investments will do. So although this bounce back's been really good for the valuation, it does kind of show how difficult it is to predict kind of how markets are going to move going forward. And going down to sort of the report a bit, the next area I wanted to draw members' attention to is the cash that the fund's holding starts in paragraph 10, and we don't normally hold this level of cash in the fund, so just wanted to highlight it. And there's 3 key drivers to this. One is the currency hedge, and we were really suffering a kind of a few years ago between sort of Brexit and even the sort of start of the COVID crisis, where sterling was weakening and we were shipping sort of cash to feed the currency hedge. So this is kind of this has turned around now, and sort of sterling has strengthened, kind of more cash has come into the fund, although it does mean unfortunately sort of investment performance is a bit lower, but that's members will remember that we have reduced the level of currency hedge, so that volatility and the sort of the cash balancing required for the currency hedge should reduce going forward. The second reason why we're holding so much cash is that throughout the crisis, Hyman's were sort of saying, you know, it's good to hold cash at the moment. There'll be opportunities as things settle down, and you kind of, you know, as the dust settles, you can see where to go. I mean, this is kind of partly the driver from our previous comment about the bounce back of the sort of the investments in COVID, and it's kind of the, you know, holding cash did seem a sensible thing to do at the time, but actually the sort of the obvious cheap assets, you know, just don't seem to exist at the moment. So again, it's kind of a temporary factor that will which will sort of unwind. And the third factor is, to be honest, is kind of one of the downsides of pooling is you're waiting for Central to get products set up. You have got a little bit of a dance about whether you keep investing with current managers or whether you hold for Central. And there's some of those products have taken a little bit longer than hoped for. We've ended up with a little bit of cash as we've just kind of holding on to things. So most of those products are now in place. The main one we're waiting for is the private debt fund, which was, although it's a closed-ended fund, so you put the money in and it's kind of trapped there for a few years, because we've been investing for quite a few years now with sort of the partners group. It is sort of returning money to us at quite a rate. So hopefully in the July investment subcommittee, we should get the approval for the central private debt fund, which will allow another chunk of this cash to go. So it's an unusual position, but hopefully kind of some of the factors driving it were just temporary, and we will be able to unwind it over the next few months. The next section of the report touched on sort of the investment plan outlines, and this is just the actions we've got in progress at the moment. And again, I won't go into detail because it is just following in line with the strategic asset allocation that was approved in January, which is highlighted in that sort of beautiful multicoloured table there on the top of page 84. And the thing I did want to highlight is you'll notice that after the July investment subcommittee, where there's a couple of proposals going to go there is a bit of lull in activity. And it's a good time for us to go out to procurement for an investment advisor. So at the moment, Hymans Robertson fulfil that role, and they tend to do the annual strategy refresh, which comes to the committee in January, and also due diligence on the various central products that launch. So but with this lull, it's a good time to go out to tender, and we're doing this purely to sort of fit with the procurement regulations. It's not driven by Hymans performance or anything like that. So the tender will get released to market in the next few days. And we'll provide a committee update in September what the sort of the state of play with that retender is. The report then moves into the performance section. It's provided there mainly for sort of members that to help summarise and sort of highlight which of the many manager reports that you may want to look into. And the first thing to note is probably in paragraph 19, although I touched earlier that kind of the bounce back from COVID has been sort of startling and kind of positive. That's on a total market level. So there is always a little bit of nervousness about the individual fund, and obviously kind of our managers and our sort of, I suppose, strategic asset allocation isn't perfectly in line with the wider markets. You do worry that the tilt on the funds could give different results, but you'll see actually in that table it is there and thereabouts. Things have bounced back. The 1 year is actually above benchmark, still suffering a little bit on the 3 year where we're below benchmark. You would hope with the active managers that we do employ that it does allow you to get back above, keep above benchmark. The point I would make on this though is although the bounce back on the overall is looking good, the private markets will tend to lag a little bit. And if you do look at the detailed performance numbers, you will see that private equity, infrastructure, property and private debt are still a little bit behind on the 1 year. So there is still a little bit of unwinding of the COVID drop in valuations to come. So hopefully some of those markets will come back to help us sort of our medium term position on the 3 year. The final point I was going to note in the performance section was that the property section is quite interesting. Obviously, kind of if you read the press, you'd sort of expect sort of the death of kind of property as a sort of an investable asset class, depending on how hysterical the narrative is at the time. And the truth is that sort of the bottom has dropped out of the sort of the retail market. But you will see that kind of there still is a positive investment return. It's only a small positive, but it is a positive investment return nonetheless on the sort of the 1 and the 3 years. And that's because although retail has been awful, offices not great, but sort of, it's not the death of the office that was first predicted, but industrial has really held up very strongly. It's obviously kind of the warehousing being the main sort of constituent of that. So although property is suffering, and it is a good area that I mentioned on cash before that we are heavily underweight, and that was conscious that we were going to be underweight on that. It hasn't been the kind of the catastrophe that maybe could have been at one point. The rest of the report was just going to further detailed points of detail, so I wasn't going to go through those, but happy to take any questions from the committee.
Thank you, Declan. Has anybody got any questions on this report? Oh, I can't see any questions. So committee is asked to note this report. Is everybody happy to do that? Yep, that's unanimous. Thanks very much. So the next item is the action agreed by the investment subcommittee and LGPS Central update. Bhulesh is going to take any questions on this item once he's done his presentation.
Yeah, I wasn't going to say too much, Chair, regarding this. It's a very short paper. It's for notes only, and it talks about the two investments we agreed at the investment subcommittee on the 31st of March, namely £200 million to the MAC product, which is multi-asset credit, and circa £28 million to Adams Street Partners Global Secondary Fund. The appendices are attached, which are the papers from the March committee. If there are any questions, happy to take them now.
Thanks, Bhulesh. Has anybody got any questions? No. So we're just asked to note this report. Is everybody happy to note it? Yep. Thanks. Thanks very much, Bhulesh. We're now on to the risk management and internal control report. I'm going to ask Chris to introduce this report.
Again, this is the usual risk management update. The report actually this time does include a kind of summary of the internal audit work we've completed, and we've got to include that summary for the first time. And you'll note from the report, we are reporting on an exception basis, so we're not including a huge amount of detail. But if I could just reassure members, if there are any particular issues, we will kind of spell out in a lot more detail in future. We did discuss kind of including actual copies of the internal audit reports as part of the agenda item, but we kind of decided against it in part because of just the length of the agenda. At the moment, you've got about 800 pages to kind of plough through. And I thought of just adding another 50, I thought would be maybe a bit of a struggle for everybody. But as I say, just to reassure you that if there are any issues, we will pull them out. That there is one new risk that we've added to the risk register, and that's the performance of the Prudential. The Prudential provide AVCs for the fund. They've introduced a new administration system which has caused some delays. Just again to reassure members, we have kind of obviously raised this directly with the PRU, LGA and other bodies, so we're kind of working through it. And Ian is on the line, who's got chapter and verse if anybody wants any more detail on that. That's all I was going to say.
Thanks very much. That's reassuring. So Chris has pointed out that if there's any high risk come through on the internal audit control, this committee will be advised of them. Does anyone have any questions or comments? No, there's no questions or comments. So we're asked to approve the revised risk register. Is that agreed? Yep, that's unanimous. Thanks very much. We're now on to agenda item 13, and this is the Pension Fund Conflict of Interest Policy. We have Kat Toohey and Lauren Haslam here to present this item. So over to you, Kat.
Thanks, Chair. This is coming to the committee following recommendations set out by the Scheme Advisory Board in their Good Governance report, which is covered a little bit later in Ian, as part of Ian's admin report. One of its recommendations sets out that each fund has its own conflict of interest policy to address how actual and potential conflicts of interest are identified and managed by those involved in the management and governance of the fund. The policy recognises that conflicts have always existed by virtue of the fact that many of those managing or advising the fund will have had a variety of other roles and responsibility for the administering authority or employee or own business interests. This does not preclude those involved from being involved in the management of the fund. It's just essential that such conflicts are recorded and managed appropriately to ensure individuals do not act improperly or create the perception that they may have acted improperly. This is intended to aid good governance of the fund in conjunction with other governing policies, such as the fund's budget, investment and funding strategy statements, and administration and communication policy, which is further details are set out in an appendix to the policy. Altogether, these policies set out the transparency of the fund and look to prevent any matter prejudicing decision-making or management of the fund. This policy does not stand alone and should be read in conjunction with the Leicestershire County Council constitutional documents, including members and officers' code of conduct, as it's recognised that these already impose on elected members, co-opted members and officers requirements regarding the registration of interests and the declaration of potential interests. This policy is intended to strengthen these documents, recognising there's specific conflicts that arise in respect of the pension fund matters, and I would specifically draw your attention to page 162, like just at the bottom of it, which sets out the pension fund specific conflicts. Appendix 1 within the policy also sets out examples of conflicts, though this list is not exhaustive, nor will all the examples give rise to significant conflicts of interest. It's important to note that the Public Service Pensions Act 2013 is clear that a person does not have a conflict by virtue of their membership of the Leicestershire Pension Fund or any connected scheme. And members are asked to always contact the monitoring officer if there's any doubt regarding a conflict or potential conflicts, and that's Lauren Haslam, who's also on the line. To simplify the process, there is a step-by-step procedure for registering and declaring interests and participation in meetings. And if this policy is approved, I will circulate a declaration of interest form, which will be provided to the monitoring officer, and continue to ask for declarations of interest at the start of every agenda meeting, and then, of course, circulate annually. We will hold that register of interest and regularly review the objectives of this policy to ensure that they are being met, and further report on the matter as part of the fund's annual governance statement. That's all I wanted to say. So if you've got any questions or comments.
Thank you, Ken. Has any member got any question? Yes, Melise.
Will you then be emailing us all a relevant form?
Yes. So after the meeting, I'll email
and then we can
everyone.
We don't have to fill it in and send it off. We can apply by email.
Yes, just by email. Okay.
Thanks, Melise. Claire, you have a question.
Thank you, Chair. Just a couple of comments and then a potential suggestion as well. Just to reassure members, this is good practice. This is going to be expected through the good governance process. There may be some guidance coming out in due course, and there may be tweaks accordingly. But generally, this is a good policy. I would recommend. I personally as well, if you need me to complete such a declarations of interest form, more than happy to do that. One suggestion might also be that the register of interests for all the members is actually made public as well. It's not explicit in the policy as to whether that is planned or not, but maybe I would suggest that.
Thank you, Claire. So.
Just a frivolous point. Unlike the equivalent in Parliament, the fact that we're debarred from the local government pension scheme does remove one potential conflict of interest.
Okay.
Just some of the representatives, like the university representative, he's not an elected member, so it could potentially be a conflict for him in any. Oh yeah, of course. Just.
Okay, so. Claire's point about the published register of members' interest being published as well.
Yeah, there's no problem having that public somewhere on our website.
Lovely, thanks. So we are asked to approve the conflict of interest policy. Is that agreed? That's unanimous. Thanks very much. So. We're now going to move on to the review of the administration 2020-2021, and Ian Howe is going to present this and the following two reports. So over to you, Ian. Thanks.
Thank you, Chair. Good morning, everybody. I'm Ian Howe, Pensions Manager for new members. This is primarily a report just for information. It's just to provide committee with an oversight of the administration that we went through in 2021. Primarily, I report to the pension board, so this is really just for openness for committee members. I don't propose to go through it line by line in the interest of time, so I was just going to mention the key areas, the key topics that we cover in the report, and then obviously welcome any questions. The areas that are included are the KPIs, the key performance indicators, an implementation of a new pension structure that we went through during the year, the ongoing McLeod Sargent ruling and how that links through into the cost cap. That's an ongoing piece of work, so you'll hear more about that over coming months. Projects that were completed in the year and the 95,000 cap. Again, that's ongoing as well, and we expect further information on that again this year, and a position on workloads. I've also included a number of the governance items, including complaints, data improvement, breaches, the audit, of which Chris mentioned that in an earlier report as well, fund policies, the actuarial tender that we went through during the year, and Hymans were the winner, the winning bidder of the actuarial tender. Knowledge and understanding for committee and board members, and a work plan again for board and committee members for 21-22. Fraud and scams, data security, business continuity, and two national items which I thought were of use for committee members. The pension regulator is proposing to bring its various codes of practice under one code of practice this year, and the Good Governance Phase 3 report, of which Kat made reference to that in the earlier report this morning. I wasn't going to propose to go into any further detail than that, but I'm obviously happy to take any questions, Chair.
Thank you, Ian. Has any member got any questions? No. So we're asked to note the report. Is everybody happy to do that? Thank you. That's unanimous. So, Ian, again, your next report is employer risks and exit.
Thank you, Chair. We'll just move ahead. Right, thank you, Chair. This report is to provide the committee with further information, and this has been to committee previously, but obviously I'm aware there's a number of new members. It's asking the committee to approve the funding strategy statement following the outcome of the consultation on regulatory changes on employer risk and exit. In addition to that, I've also added a fund policy on employer risk. That is simply designed to help our employers, make it a little bit more explicit to them and for them to understand how employer risk is working within the fund. Effectively, I won't go into huge detail, but last year in September, there were some new regulatory changes that introduced 3 areas of potential change. They aren't specific in terms of funds having to use them, but there are some useful points in there. So we were keen to look at this. They cover the review of employee contributions, spreading exit payments, and something called a deferred debtor range agreement. The fund did a consultation with the employers that followed this report coming to the committee, and the consultation ended on the 28th, I beg your pardon, of February. Just after the consultation ended, MHCLG produced some statutory guidance, and then on the 5th of March, Scheme Advisory Board provided further guidance. That was unfortunate timing, that just after our consultation had ended. We took internal legal advice, and it was confirmed that both the MHCLG guidance and Scheme Advisory Board guidance didn't impact on the fund's view or any other wording in the funding strategy statement. So that was very good. That was positive. I did have a little bit of feedback from employers, nothing negative. Most of it was just for further understanding and for greater clarity in terms of how it kind of impacted on them and on particular cases they may already have. But there was nothing negative. In fact, it was positive. In addition, as I say, I expanded the wording in the funding strategy statement to make it a little bit more explicit to help employers in the area around where there is an exit surplus. So when an employer leaves in surplus, what we do in that, and that was highlighted in green in the funding strategy statement. This is just asking the this then went to the board as well, I should say, in May. So the board were support. It's just to ask then committee to approve that if that's okay, or any questions. I'm obviously happy to take them.
Thank you, Ian. Does anyone have any comments or questions they want to raise? No. Okay, so we are first asked to approve the revised funding strategy statement. Is that agreed? Oh, sorry, Zubair. Sorry, before we do that, Zubair, your question.
Thank you, Chair. It's not a question really. I just wanted to say thanks to Ian. I think seeing that information since February and where it is now in terms of it's confirmed, I would agree that it does help employers in terms of clarity, the funding strategy statement, as well as I think the extra appendix you put together in terms of defining how employer risk is determined. I think it's really helpful as well. So just wanted to make that comment as opposed to a question.
Thank you, Zubair.
So we are first asked to approve the revised funding strategy statement. Is that agreed? It's unanimous. And second, we are asked to approve the fund policy on employer risk. Is that agreed? Yeah, again, unanimous. So our final item on today's agenda is the National Youth Agency. And again, Ian, this is a report for you to present.
Thank you, Chair. Yeah, this report kind of nicely follows the last one in some regard because it links to employer risk. And this is a real example of where the fund is working to reduce employer risk. So I thought I'd do a kind of a summary of the report, if I may, just to talk it through with yourselves. The National Youth Agency is one of our most historic employers in the scheme. They're known as a community admission body, a CAB as we call them. We only have a very small number of CABs in the fund. They tend to be old charities without security or guarantor that sits behind them. And that's again purely because of the historic nature. When these employers joined the fund, pension fund risk wasn't even a consideration really in truth. National Youth Agency have got no active employees. And they've been working really, really hard over a number of years to pay off their deficit within the pension fund. And they've made some significant inroads. They've been really good, and they're very, very supportive of the fund. They work very well with us. As at the 31st of March 21, there was actually no longer a deficit. Instead, they were sitting at an approximate surplus of around about 900,000. Now, under the previous report where I talked about surpluses, we checked with the National Youth Agency, and there was no pension risk share involved when they started, which is not surprising given the nature of the historic version here we're talking about. But for completeness, I did double check with them, and they confirmed they have no risk share. Therefore, they have no entitlement to any of that surplus back. Now, what's being proposed here is to move the assets and liabilities from the National Youth Agency over to Leicestershire County Council as a fund employer. That will actually allow National Youth Agency to walk away from the pension fund. That means they've met all their responsibilities as an employer, and they can then walk away, and they have no further risk or liability under the fund. It's also good for the county council because reputationally, we don't want to see any employer, particularly a charity of this nature, get into any financial difficulty due to the pension scheme. Officers at the county are willing to allow the proposal to move the assets and liabilities over to the county if the pension committee are in approval. It will need, however, the county council's cabinet for formal approval before this is actually decided. So this is one step towards the ultimate step, which will be for cabinet to make the decision on behalf of the county council. But this is primarily at this point here because we are trying to reduce the fund risk, and that's why it's coming to committee prior to cabinet. That's all I was going to say, but I'm happy to take any questions, Chair.
Thank you, Ian. Has anybody got any questions they'd like to ask regarding this? So I know we haven't got anybody. So we are asked to support the proposal set out in the report to go to Cabinet for agreement. Is everybody happy? Oh, sorry, Zubair, you've got another question. I didn't see your hand. Zubair.
Yeah, thank you, Chair. Just a quick question I wanted to find out was, if I understand correctly, if this proposal is accepted, and I can understand the logic behind it, in terms of the other employers in the fund, I would understand would then have to pick up the burden of the remaining liability across all other employers. Is that right?
Zubair, yeah. If an employer goes bankrupt within the fund, which is obviously something we're trying to mitigate, we're trying to avoid that clearly. That's the worst case scenario effectively. So we do everything we can to avoid that. But if that was to happen, Zubair, the first line of call would be to check if there is any security in place. Now, for a lot of the employers, there is security in place. So there'll be a guarantor, which is normally the employer that's done the outsourcing originally, or indeed a bond. So we could fall upon the bond. But because of the historic nature in this instance, because there is no guarantor that sits behind them and there is no bond that sits behind them, you're absolutely right. If this was to go, if the National Youth Agency was to go bankrupt, the cost would then be spread across all the employers in the fund, which is something we're trying to avoid.
So in this context, then they're not looking at, it's not a bankruptcy situation. It's a conscious decision that's been made to propose to move those remaining liabilities and assets into the pension fund. I think the point I'm really getting at is there something that, I suppose, is there anything which has been undertaken in terms of what the impact would be on the existing employers in the scheme should this proposal go through?
There wouldn't be any other impact on any of the existing employers, Zubair. This would become a county council as an employer responsibilities. So it would sit under the county council under this proposal. So it wouldn't impact on any of the other employers, Zubair.
Okay. Well, thank you. That's important clarification. Thank you. Appreciate that.
Okay, no problem.
Thank you, Zubair. A good question. So we are asked to support the proposal set out in the report. Is everybody happy to do that? So this will go to Cabinet for agreement. Thanks very much. Thank you. So the next item, that was the last item, the date of the next, thanks very much, Ian, for presenting those last three reports. The date of the next meeting is the 10th of September at 9:30. We have got another item to consider in private. I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining items of business on the grounds that they involve the likely disclosure of exempt information.